Good morning and a happy new year to everyone monitoring the Beta 2 market reports. Today, all I really wanted to do was look ahead to 2016. And I think the best way to do that is to look back at what happened in 2015. Now, one thing's for sure, and I think everybody's very aware of this, it was, regardless of what market you operated in, a very, very volatile market climate. Now, if we look at the main factors why this happened, and the reason we're doing that is very simply because we believe it will assist with looking forward to this year's marketplace. So 2015, let's go back almost a year, January the 15th. Swiss National Bank shocked the markets when they unpegged the Swiss from the euro. On the back of that, we see market movements in the FX arena we literally hadn't seen for many a decade. Now, very simply, when they removed the peg, Euro Swiss moved from 1.20 to parity within the same day. At one stage, it actually went as low as 0.80, a movement of over 33% in a major currency pair in one day. Safe to say, it was a very volatile start to the trading year. And really, it gives us an idea of what may lie ahead. Now, in regards to the rest of the year, the Grexit, which is obviously the potential of Greece leaving the Eurozone, was once again one of the biggest factors affecting the market climate. Eventually this was resolved, a bailout was agreed, and the late payments to the IMF were forgotten, and the market uncertainty and volatility did die down. But again, yet another reason why we've seen the plethora of volatility that we witnessed. Now, as well as that, we've seen massive uncertainty in China, and China again we believe will play a very large part moving forward into 2016. The economy slowed down. Official projections suggested in the second half of last year their economy grew at 7%. Realistic projections suggest it was closer to 2 or 3%. On the back of this, it had a massive effect on the financial markets and the volatility. It brings me on to my fourth point, which is a commodity arena. All financial markets are correlated either directly or inversely, and what we've seen last year was nothing less than an obliteration in the commodity arena. If you take copper, for instance, China actually takes up 50% of worldwide demand for copper year on year. Now, on the back of the slowdown in China, copper was actually down at levels we hadn't seen since before the credit crunch. It was as traumatic as that. Now, if you look at energy, soft commodities, industrial metals, it was similar across the board. Now, they were the main reasons why the markets were as volatile as they were last year. As well as that, you've obviously got the UK election uncertainty creating volatility, particularly this side of the pond. But moving forward to 2016, are any of those still in play? Well, we would say yes. China, most certainly. Just have a look at this week. We're a few days into the trading year, and already we're seeing massive volatility and uncertainty on the back of China. And again, that's having a massive impact on the commodity arena. So if we use commodities and we use China as two fundamental plays definitely still in place, we'd like to throw one other thing to keep an eye on this year, and that will be the interest rate story worldwide. What do I mean by that? Well, very simply, ever since the credit crunch, we've been looking at a couple of things. We've been looking at interest rates being cut and governments and central banks doing whatever they can to push forward economies, stimulus measures. This has started to change. Last year, America were the first country to start raising their rates of the major economies, and what we may see now is a gradual increase in rates in the United States of America. This may be followed by the UK if Mark Carney obviously follows suit and starts to raise those rates as well. But the inverse is there for the ECB, the Bank of Japan and China, where again they are still making measures and implementing measures which they believe will stimulate their economy. So what we're seeing there is a divergence in the interest rate policy of major economies, and it should have a large effect on the financial arenas this year. So what do we expect? We expect some volatility in all asset classes, and we expect some strong movements. The hope here is obviously we can align effectively, and for any clients out there, we've obviously sent our yearly projections out already, which obviously provides more depth in regards to what I've discussed today. Anyway, that's it for now. Obviously, I don't want to take up too much of your time. Thank you very much for obviously watching this report, and good luck for 2016 in both the investment markets and life in general. Thank you very much.